commercial real estate is in some serious trouble right now, along with residential real estate. But, commercial real estate, I don't know the scale of the bubble. It's harder to get information on commercial real estate. I know that a building recently that was in New York City that sold just a couple of years ago for $65 million just went for 16. And that is a pretty large price decline. The problem is, as you know, commercial real estate is when you go to refinance, the bank is going to value that piece of property not by the structure and the location as much as the rental income that is coming from that property. And so after COVID, we've had these very high vacancy rates. Occupancy might only be 50% on a building, where normally it would be at like 92% or 96%. And here we are at 50%. So the bank takes a look, and then people with it at 50%, any new offices that get rented or whatever, retail shops, get rented at lower rates because there's competition to get these spaces filled. And so the dollar amount of rent is going down, and then you've got all these vacancies. And so when you go for you were just telling me that 30 years don't exist and 15 years. So what is the term on your typical commercial real estate loan? And, what kind of trouble do people get into when the building appraises at half what it did before, and they've got to roll over a loan at these higher interest rates with much higher payments?
Well, and that's really double where, a lot of people are. So a lot of the real estate, the commercial loans are at about 3 3/4 to 4%. And now we're sitting at, a solid 8%. So anybody coming up for refinance, they're literally looking at the interest portion of their debt is doubling. But that's not really the problem. So you have two scenarios that play out with commercial real estate. And the terms, Mike, typically are 5 and 10 year terms. And, over the last 5 years, no one wanted to give a 10-year term. Well, very few wanted to give a 10-year term because they knew they were at historically low rates and they were banking on this rate increase, this hike. But really, there are two types of, situations here with the commercial. One is a recourse borrower, and the other would be a non-recourse borrower. So meaning the recourse borrower is where the bank gave them the money, whether it's an owner-occupied building or not, meaning that the borrower maybe has their business located in that commercial real estate versus it just being for speculation, for tenant speculation. So that recourse borrower is really the one that's in the most trouble right now because, individually, when a borrower buys a commercial property, not only is the bank, going after them, signing a personal guarantee, but they're cross-collateralizing all of their assets that they have. And that means their businesses, sometimes their spouses get included in the note, as far as guarantors, and it can even extend to their home. So these are the ones that are really in the biggest trouble, that are up for refinance, that are struggling to do so. The non-recourse simply turn their keys back in. And for a lot of these borrowers, they're only out, their risk is just their deposit, which may be, 20%, 25, 30% of what they originally purchased. They're kind of capped out at that down payment that they, when they originally purchased the property. Sometimes investors are even the ones that help to raise that money. So, that's diluted on the larger scale to a lot of these borrowers. They just turn the keys back in. But let's just talk about the recourse borrowers, because that's a lot of America, right? So these are the people that, tried to do a little bit better for themselves, maybe wanted to own the building that their business is in, and maybe they have multi-tenants, they only occupy one space, or maybe they're occupying the whole building and their business is just down over the last several of years. So now they have to refinance that property. They have to requalify all over again. So if the bank is analyzing that property from a cash flow basis and it's not cash flowing, or there's rent delinquencies or vacancies, they might not even have an appetite for a refinance at all. And a lot of the different classes of real estate, the banks throughout time, they get overweighted in certain classes. So a lot of these that own the office space, office buildings, even if you have the ability to repay it, they're not comfortable with the office space at all. And they'll require that that building owner, to come up with a huge amount of cash to refinance. And it could be millions of dollars in cash out of pocket, which the owners may not have. And the rates are going up, and the whole rules just are going to change. And I think that what has happened here in the last several decades, Mike, is we have glamorized real estate investing. And we've glamorized it to the point to think that over the last 10 or 15 years, there really hasn't been any risk, because interest rates have been low and the economy has been chugging along. But I think everybody knows, especially the banking sector, they know that it's not as rosy as, mainstream media is putting out. And they're the ones that are looking at their assets going, look, now's our chance, guys. We need to restructure this. We're in trouble. And Mike, I know you're prepared to show some information on the banking, sector, but that's really, It's a mess. What we have going on right now is a disaster in the commercial real estate space, especially if you're an office building holder. And now I'll just segue into this just briefly. On whitehouse.gov recently, they just published a fact sheet where the Biden administration, what they want to do is they're putting in play this, rehabilitation. Here we go, October 27th. But what they want to do is they want to convert. They know the banks are in trouble with office space. So what they put was this plan out to convert commercial office buildings into residential. And they want to kind of incentivize this whole plan. The problem is when the government, I don't care who the administration is, but when the government shows up and says, hey, I'm here to help, we can just pretty much, go, oh, geez, here we go. Right. And it never really works out well. Here's the problem, Mike. It is common knowledge. I mean, you can Google search this. You can check it out. We are going to be in a glut of multifamily housing. What the government's plan to come up with, converting these office buildings into multifamily housing, is probably the worst idea that I've heard yet in the near term, considering the fact that we have over 1 million in production right now that's going to hit the market in the next 12 months of multifamily housing all over the place. Cranes have been occupying the skylines, building apartment buildings. And they're now getting, these apartment operators are now realizing they need capital calls. They can't even continue their construction in some cases. And now they're going to be looking at some of the highest vacancy rates we've seen in multifamily housing in decades. So, I think, that's just the tip of the iceberg. But one more thing before I let you go back into the charts, this is even crazier. A lot of people think that the housing market, and we're showing it's not as solvent as you'd like to believe, because FHA now has a new plan they just put out for comment in May. They have this plan because they know that all the bailouts haven't worked. They know that, all of the forbearance, mortgage forbearance hasn't really worked. We're now looking at FHA delinquencies, and FHA is the new subprime lender, in my opinion. They're the Lehman Brothers, essentially, the government's the Lehman Brothers back in the leading up to the 2008 crisis with subprime. And basically what's happening now is we've got almost 10% delinquencies in FHA, despite all the bailouts, despite the mortgage moratoriums. And now the FHA just came out with this new program they want to launch where they take, I think, up to $1,000 off of people's mortgage payments, as if the 40-year mortgage wasn't enough, taking 30% of the mortgage debt, putting it on a second mortgage in the back, interest free, wasn't enough. Now they want to drop their mortgage payment by up to $1,000 a month for FHA borrowers struggling. And they want to do this for a minimum of 3 years. And a maximum of 5 years. Right here it is, FHA mortgage reduction plan. So, this is brand new stuff that they're hoping, this administration's hoping to get out by the end of the year, Mike, that, that they will be able to hopefully continue their administration in the 2024 election.
Yep. It's, you're blowing a balloon up and it develops a hole and you slap a Band-Aid on it, but you keep on blowing. They're just making this bubble bigger and bigger and bigger. And they keep on slapping Band-Aids on, any problem that develops. But the Band-Aid that they're creating just puts more air in the balloon. And it's going to end up being disastrous. So anyway, this was where we were back in 2008 when real estate crashed. So bonds were not in a hyper bubble; they were becoming, overvalued. But this was the trigger that started it all. And I made videos on this as soon as they started raising rates. This is the year over year percent change in the rate increases. And it's like Powell didn't seem to understand that raising the rates a quarter point or a half point from when you start from 8%, like we did back in the 70s or 80s, up to, you go up half a point. If you're at 10%, you go up half a point, you're talking about a 5% year over year change. And here, when you're talking about 0.1% and you go up this is a 4,500% year over year rate increase is where this chart peaks. And that rate of change is what has upset the apple cart. And I'm surprised that things have lasted as long as they have, that the economy has held together for the past year and a half. But I think, by the time we get the rate cycle started in March, so we're coming up on 2 years, I believe, of this rate hiking. And it's all going to come to an end soon, I believe.
Mike, you know what the craziest part about this chart is? This is almost how silly it is, right? This is the Federal Reserve's chart. I mean,
I make these on the Federal Reserve's website.
Right? Yeah. I mean, when you look at this chart, this is the Federal Reserve's chart. They created this chart. So when you look at it, you say, what were they thinking?